Have you ever wondered how banks make money beyond just lending and collecting interest? Or how a seemingly simple loan can become a tradable asset? The answer often lies in a complex process called securitization. It sounds intimidating, but we're going to break it down into something easily understandable. So what is securitization? At its core, it's the process of taking an illiquid asset, something that's hard to quickly turn into cash, and transforming it into a marketable security. Think of it like this. You have a bunch of individual puzzle pieces. They're not easy to sell individually, but if you assemble them into a complete picture, it's much easier to find a buyer. Securitization does something similar with loans. Now, why is this relevant, especially for a U.S. audience? Well, securitization played a huge role in the 2008 financial crisis, and understanding it helps us understand why that crisis happened. But it's also a fundamental part of the modern financial system. It allows banks to free up capital, making more loans available to consumers and businesses. It impacts everything from mortgages and auto loans to credit card debt and even student loans. Let's look at a simple example. Imagine a bank makes a lot of home loans mortgages. These mortgages are assets for the bank, but they're not exactly cash in hand. They're illiquid. The bank can't just instantly turn them into spendable money. So what does the bank do? It pools these mortgages together, let's say 100 mortgages, totaling $20 million. This pool of mortgages is then sold to what's called a special purpose vehicle, or SPV. Think of the SPV as a separate company created specifically for this transaction. It's legally distinct from the bank, which is important for risk management. We'll touch on that later. The SPV doesn't just buy the mortgages with cash. Instead, it issues new securities, bonds backed by those mortgages. These bonds are sold to investors. So, investors are essentially lending money to the SPV, and the SPV is using that money to buy the mortgages from the bank. Now here's the key. These bonds are considered asset-backed securities because their value is derived from the underlying assets, the mortgages. Investors receive payments on their bonds from the cash flow generated by the homeowners making their mortgage payments. Let's simplify even further. You have a bank, a bunch of mortgages, an SPV, and investors. The bank gets cash from selling the mortgages to the SPV. The SPV gets cash from selling bonds to investors. Investors receive payments from homeowners. Everyone benefits in theory. But what if homeowners start defaulting on their mortgages? This is where things get complicated and where the 2008 crisis comes into play. When defaults increase, the cash flow to investors decreases, and the value of the asset-backed securities declines. To manage this risk, securities are often divided into tranches. Think of tranches like layers in a cake. Each tranche represents a different level of risk and reward. The top tranche is considered the safest, receiving payments first and bearing the least risk. The bottom tranche is the riskiest, receiving payments last and bearing the most risk, but also potentially offering the highest return. During the 2008 crisis, many of the securities backing these tranches were based on subprime mortgages, loans given to borrowers with poor credit histories. When housing prices fell, many subprime borrowers defaulted, causing massive losses for investors who held the lower tranches of these securities. The complexity of these securities and the lack of transparency made it difficult to assess the risks, contributing to the widespread panic and financial collapse. Securitization isn't limited to mortgages. It's also used with auto loans, credit card debt, student loans, and even royalty payments. The basic process remains the same. Pool the assets, create an SPV, issue securities, and sell them to investors. So why do banks bother with securitization? It frees up capital. By selling loans to the SPV, the bank gets cash immediately, which it can then use to make more loans. This increases the bank's lending capacity and stimulates economic growth. It also allows banks to diversify their risk. By selling loans, they're no longer solely responsible for the risk of those loans defaulting. However, it's crucial to remember that securitization isn't a risk-free process. When done responsibly, with transparent and well-understood securities, it can be a valuable tool for the financial system. But when it's used to mask risk and create complex, opaque securities, it can lead to disaster, as we saw in 2008. To recap, securitization is the process of turning illiquid assets, like loans, into marketable securities. It involves pooling assets, creating a special purpose vehicle, issuing bonds backed by those assets, and selling those bonds to investors. It allows banks to free up capital and diversify risk, but it also carries inherent risks, especially when it's not done responsibly. It's a complex process, but understanding the basics is crucial for navigating the modern financial landscape. Remember, this information is for educational purposes only and should not be taken as financial advice. Always consult with a qualified financial professional before making investment decisions.